Welcome back to Skytech-Lens. In early 2025, the U.S. government, under the leadership of President Trump, made a bold and controversial move by announcing a sweeping 25% tariff on all cars and car parts imported from Japan. The administration justified this decision by citing national security concerns, arguing that the heavy reliance on foreign-made vehicles and components could put the country at risk in times of crisis. This announcement marked a significant escalation in trade tensions between the United States and one of its closest allies, sending immediate ripples through both political and economic circles. The primary goal behind this tariff was clear: to make Japanese cars and parts more expensive for American consumers, thereby giving U.S. automakers a much-needed competitive edge in their own market. For years, Japanese brands like Toyota, Honda, and Nissan have dominated American roads, prized for their reliability and affordability. By raising the cost of these imports, the administration hoped to encourage consumers to buy American-made vehicles, boosting domestic production and supporting American jobs in the auto industry. The rollout of the tariff was carefully staged. It began with finished vehicles, immediately impacting the price of new Japanese cars arriving at U.S. ports. Over the following months, the tariff expanded to include car parts, affecting everything from engines to electronics. By August, the full 25% tariff was in effect, touching every aspect of the Japanese auto supply chain entering the U.S. This phased approach gave businesses some time to adjust, but the impact was still swift and severe. The global auto industry was rocked by the news. Stock markets reacted with volatility as investors tried to gauge the long-term effects of the tariff. Auto manufacturers, suppliers, and workers around the world braced for uncertainty. Headlines warned of a looming crisis, with fears that the move could trigger a broader trade war, disrupt supply chains, and lead to job losses not just in Japan, but in the U.S. and beyond. Japanese automotive giants like Toyota and Honda, both of which have invested billions in U.S. factories and employ tens of thousands of American workers, suddenly faced a massive financial barrier. Their business models, built on efficient global supply chains and competitive pricing, were thrown into question. Executives scrambled to assess the impact, holding emergency meetings and considering how to respond to this unprecedented challenge. The big question on everyone's mind was, who would ultimately bear the cost of this tariff? Would Japanese automakers absorb the extra expense, cutting into their profits? Or would they pass the cost on to American consumers, making cars and repairs more expensive for millions of families? Dealerships, buyers, and workers all faced a period of uncertainty, unsure how the new reality would affect their livelihoods and choices. As the world watched, the stage was set for a major economic confrontation between two of the world's largest economies. The outcome of this standoff would not only shape the future of the auto industry, but also test the resilience of global trade relationships and the balance of power in international commerce. For decades, Toyota and Honda have been pillars of the U.S. auto industry, employing thousands in American factories. Their presence wasn't just about building cars. It was about building communities, supporting local economies, and providing stable, well-paying jobs to generations of American workers. These plants became symbols of international cooperation, blending Japanese engineering with American craftsmanship. Families relied on these jobs, and entire towns grew around the steady hum of these factories. The impact of Toyota and Honda went far beyond the assembly line, touching schools, small businesses, and local governments that depended on the economic activity these companies generated. But everything changed when the new 25% tariff was imposed. This tariff didn't just target finished vehicles rolling off the line, it also hit the countless parts shipped from Japan for assembly in the U.S. Suddenly, every bolt, engine, and electronic component became significantly more expensive. The cost of doing business skyrocketed overnight, putting immense pressure on the entire supply chain. Suppliers, logistics companies, and even local service providers felt the ripple effects as the price of imported parts soared. The competitive advantage that made U.S. manufacturing attractive for Toyota and Honda began to evaporate. Suddenly, building cars in the U.S. became unsustainable. The once busy assembly lines slowed, then stopped altogether. Factories that had operated around the clock for years now sat eerily silent, their machinery idle. The cost structure no longer made sense, and the companies faced mounting losses with every car produced. The uncertainty spread quickly, with workers and managers alike fearing for their futures. The sense of pride that came from making cars in America was replaced by anxiety and doubt. After weeks of intense analysis and difficult discussions, both companies announced in June 2025 that they would close major U.S. plants and shift production to countries like Mexico and Thailand, where tariffs didn't apply. The decision was not made lightly. Executives weighed every possible option, but the numbers simply didn't add up. Moving production overseas was the only way to keep their global operations afloat. The announcement sent shockwaves through the industry and devastated communities that had depended on these factories for decades. The financial hit was staggering. Toyota projected a $9.5 billion loss, while Honda's profits were slashed in half. Investors reacted with alarm, and stock prices tumbled. The losses rippled through the global auto market, affecting suppliers, dealerships, and even rival automakers. The closures marked one of the most significant setbacks in the company's histories, forcing them to rethink their strategies for the future. Closing U.S. factories was a drastic but necessary move to survive in a newly hostile market. For thousands of workers, it meant the end of an era and the beginning of uncertainty. For the auto industry, it was a wake-up call about the far-reaching consequences of trade policy. And for communities across America, it was a reminder of how quickly fortunes can change in a globalized world. The closures meant more than lost headlines. They meant lost livelihoods. Around 500,000 American jobs tied to Japanese automakers were suddenly at risk. For many, these were stable, well-paying jobs that supported entire communities. The ripple effect was immediate. Local businesses suffered, main streets emptied, and tax revenues dried up. Towns built around these factories faced economic collapse. The pain of a policy decision in Washington was felt most acutely in the heartland, where families and communities struggled to pick up the pieces. Tariffs don't just hurt companies, they hit consumers. The 25% tax on Japanese cars and parts meant higher prices for everyone. A family sedan that once cost $25,000 could now be $30,000 or more. American automakers, facing less competition, raised their prices too. Used car prices soared as buyers looked for alternatives. Businesses relying on fleets faced higher costs, passing them on to customers. The tariffs' impact rippled through the economy, making reliable transportation less affordable for millions. Beyond the world of cars and trade, there's a deeper, less visible connection between the United States and Japan, one that shapes the global economy every single day. This connection is built on a foundation of debt, a financial bond that ties the two nations together in ways most people never realize. While headlines often focus on products and tariffs, the real story is about money, massive amounts of it, flowing quietly across the Pacific. The U.S. relies on foreign countries to buy its debt, and Japan is at the very top of that list. Japan is the largest foreign holder of U.S. Treasury bonds, with a staggering investment of over $1.1 trillion. That's more than the GDP of many countries, and it means that Japan plays a crucial role in financing America's government spending. Every time the U.S. needs to borrow money, it counts on buyers like Japan to step up. This unique relationship helps keep U.S. borrowing costs low, making it cheaper for the government to fund everything from infrastructure to defense. But it's not just a one-way street. By holding so much U.S. debt, Japan gains a quiet but powerful form of leverage over American financial policy. It's a delicate balance, one that both countries are careful to maintain. When trade tensions flared and tariffs were threatened, Japan subtly hinted that it might start selling off some of its U.S. debt holdings. This wasn't just a financial move, it was a warning. If Japan were to unload even a fraction of its treasury bonds, it could send shockwaves through American financial markets, driving up interest rates and rattling investors worldwide. Suddenly, what began as a dispute over car imports and exports was threatening to spiral into a full-blown crisis for the entire U.S. financial system. The stakes were no longer just about jobs or factories, they were about the stability of the dollar itself. In this high-stakes economic standoff, Japan's massive holdings of U.S. debt became a powerful bargaining chip. It was a reminder that in the world of global finance, the most important moves often happen behind the scenes, where quiet decisions can change the course of nations. The mere suggestion that Japan might sell U.S. bonds sent shockwaves through financial markets. Investors panicked, bond prices fell, and interest rates spiked. In 1 week, the 10-year Treasury yield jumped to 4.59%, the sharpest rise in decades. Higher government borrowing costs quickly translated into more expensive mortgages, car loans, and credit cards for ordinary Americans. Analysts warned that even a small sell-off by Japan could push mortgage rates up by 0.5%, costing families hundreds more each month. The trade war was now threatening the financial stability of millions. Rising interest rates and market turmoil made it harder for businesses to invest and hire. Stock prices fell, shrinking retirement savings for millions. Even companies not directly targeted by tariffs, like Subaru and Mazda, froze investments and withheld forecasts. The Federal Reserve watched nervously as the trade dispute, not economic fundamentals, drove instability. What began as a fight over cars had become a threat to the entire U.S. economy, stalling innovation and job growth. Mounting economic damage forced the U.S. and Japan to negotiate. In July 2025, they struck a deal. The U.S. lowered the tariff on Japanese cars to 15%, but kept the 25% tax on imported parts. Relief was short-lived. American automakers complained the deal gave Japanese companies an edge. Toyota could import finished cars at a lower tariff, while U.S. firms still paid more for parts. The compromise calmed markets but left deep doubts. The truce stopped the bleeding, but the underlying wounds remained, and the future of the auto industry was still uncertain. The July deal paused the crisis, but risks lingered. The U.S. still faced job losses and a weakened auto industry, while Japan's car makers struggled with high tariffs. The episode exposed America's vulnerability to foreign creditors and damaged trust between two longtime allies. Both economies were left more cautious, more divided, and more aware of the far-reaching consequences of trade wars. Without a lasting solution, the threat of renewed conflict and more pain for ordinary people remained just over the horizon. Thanks for watching. Subscribe to the channel for more updates.